Hello, investors. March has been volatile, and most developed markets have delivered negative returns for the month so far. This is primarily due to the current uncertainty surrounding the banking sector. It is important to note that while InterestMe Wealth has no exposure to Silicon Valley Bank, Credit Suisse, or any of the other associated banks in the recent turmoil, we are not immune to the systemic market movements. The past 3 weeks have been plagued with volatility and uncertainty, mostly focused on the banking sector. The first of the problems came to light when a major US venture capital firm collapsed due to its full exposure to cryptocurrencies and their subsequent decline. Following on from that, Silicon Valley Bank, a prominent bank in the US that specialized in lending to tech startups, collapsed on Friday, the 10th of March. This occurred because worried depositors withdrew significant sums from the bank, following its announcement that it needed to raise money to shore up its balance sheet. By Sunday, 12th of March, the federal government had stepped in and the bank was closed to new business. The fear and panic this caused spread to other financial institutions, with stock prices across the industry getting hit, particularly small regional banks. The knock-on effect flowed into Europe and Credit Suisse. Credit Suisse was the second largest bank in Switzerland and had been operating for over 150 years, but in recent years was poorly managed. After customers began pulling their funds at an alarming rate, the Swiss government intervened to broker a deal between UBS, the largest bank in Switzerland, to acquire its former rival, Credit Suisse. The result of all of this has been increased volatility and falling equity prices. The pound-dollar rate stayed stable over March, starting at $1.20 per pound and rising to $1.23 as at 23rd March. We believe currency fluctuations will continue to play a significant role in investor returns this year. As we have long been saying, we believe interest rates have not yet peaked. Central banks continued their upward march, with the Federal Reserve and Bank of England raising rates by 25 basis points on 22nd and 23rd of March respectively, and the European Central Bank raising rates by 50 basis points on the 16th of March. Rates now stand at 4.75, 4.25 and 3% respectively. Given the banking turmoil that had already taken place in the last few weeks, markets were unsure if rates would continue to go up as previously anticipated. We believe central banks are still focused on fighting inflation and rates will continue to rise across the board. Our economic and market outlook remains the same. We are still expecting a significant correction in equity markets, but at different stages across the various major geographic indices, i.e. US, Europe, and Asia, etc. The recent turmoil has only highlighted the headwind that sustained interest rates rises are having on global economies, particularly impacting upon less well-capitalized, poorly run businesses. However, central bank leaders have continued to reiterate the point that elevated interest rates are here to stay until they have inflation under control. Therefore, we believe that equity markets are in for a prolonged period of volatility. We have made some changes to our asset allocation recently. In February, we increased to an overweight position in fixed income and significantly decreased our cash levels. This month, we have sold out of our India and market neutral exposures, and we utilized the proceeds from these sales to invest into an emerging markets index tracker, which we think is at an attractive entry price point and offers better risk-adjusted returns than the funds we sold out of. As aforementioned, we're continuing to monitor equity index prices, and we expect to invest back into our benchmark equity levels as individual indices fall to our target prices. As always, we encourage you to contact your financial advisor should you have any immediate concerns. If you have any further questions for us, we of course welcome them and ask our clients to contact us on the email on your screen. Thank you.